Hello and welcome to Intermediate Accounting 2, Chapter 19, Pensions. This chapter is going to go through two videos. There's two videos on this chapter. The first one introduces the types of pension plans and goes into a bit of detail in the defined benefit plans. And then the second video will take a look at more of IFRS for the defined benefit plans. All right, so there's a bunch of different benefit plans. The main one that we're going to look at in this chapter is pensions. So pensions and other types of post-retirement plans like healthcare, life insurance. There's also post-employment benefit plans such as severance benefits, long-term disability benefits, and then there's compensated absences such as parental leaves, sabbatical. So we need to determine as accountants how to account for this on the books. So we're going to look at pensions mostly, and then there's a couple of slides on the other ones at the end in the second video, but this video is all going to be about pensions and how to record them. So a pension plan provides benefits to retirees for services that they provided while they were employed. So this pension is given to the employees after they have retired. What the company has to do during the time of these employees' employment is fund the pension plan. So they need to make sure that there's enough money in that pension plan throughout the years in order for the employees to get the money when they retire. So the employer contributes into the fund and incurs the cost of having the pension plan during the years of employment of the employees. So plans can be either contributory or non-contributory. A contributory pension plan means that both the employer and the employee contribute to the plan. So maybe the plan is that the employer contributes 6% of the employee's salary and the employee also contributes 6% of their own salary. Or it's a fixed number, like $1,000 or something. So they will set up how much will be going into the pension plan per year, but both the employer and the employee contribute to it. So maybe the employer contributes 6% and the employee does 3% or the other way around. It's going to really depend on the setup of the pension plan. Or they can be non-contributory. A non-contributory pension plan means that only the employer contributes to the plan, not the employee. So you have your company putting in money into a pension plan for you, for the employee, but the employee does not have to also contribute part of their salary into their pension plan. These days, the more popular one is contributory pension plans where both the employer and the employee contribute to the plan because it does work out to be cheaper for the company. All right, so this is how things work. So what happens is the employer will pay cash called contributions or funds into the pension plan. So then we have this pension fund where all the cash is going into the pension fund. And then from that pension fund is where the retirees receive their pensions or receive their benefits. Okay, so contributions are, the word contributions are used when an employer puts money into the pension fund, and the word benefits are used when the retired member can take out the money. So when the retired member takes out the money from the pension fund, that's called benefits. So basically the only responsibility for the employer is to put the money into the pension. So what the employer does is they put the cash goes into this pension fund, and then usually another company will take care of these funded assets and they'll take care of the money that's going into or going to the retirees. So what happens is there's like a trust company or a trustee. So a trustee will take care of the money that the employer puts into the pension fund, and the trustee will also take care of giving the retired members their benefits. So all of what the employer does is just putting cash in, and then the pension fund or the trustee, the company that deals with the pension, they'll take care of everything else. So these assets get invested. Okay, so they just don't stay in cash. They get invested, they make some more money, if they make some good money, then the employer may not have to put as much into the pension fund. We'll talk about the different types of pension funds in a bit. But basically, the employer is putting cash in the pension fund, and then after that, they're done with their responsibility. So all the employer does is give the cash, and then after that, the trustee or the pension fund takes care of paying out the members, takes care of figuring out what to do with the money. So then they do all of that. And that's important to know for when we do our journal entries, like what the employer is responsible for. So there's two types of pension plans that we're going to talk about. There's defined contribution plans and defined benefit plans. So we'll talk about both of them. We're going to go through the journal entries for both and figure out how they are different. So defined contribution plans, what that means is the contributions are fixed and the benefits are variable. So again, contributions mean the cash contributions that the employer puts into the pension fund. And this could, if it's a contributory pension plan, the employee portion will come out of your salaries expense, the employee salary expense, and then the employer portion will be the contributions. Okay? So in a defined contribution plan, the contributions are fixed. So what this means is that what the employer puts into the pension fund is fixed. So the employer could say, we're going to put 6% of everyone's salary into the pension plan each year. Okay? So that's fixed. It doesn't change 6% of your salary, or they come up with like a nice number of how much they're going to put into the pension fund for their employees. So they might say, you know what, for all our employees, we're going to put $60,000 into the pension fund each year for all our employees. So contributions are fixed. The employer knows how much money is going into the pension plan each year. Okay? So they can calculate it. Okay? So these are the employer. So employer contributions are fixed. Okay? Sorry, employer contributions are fixed. They know how much, generally they can calculate it. They know how much is going into the pension fund every year. Benefits that the retirees get. So the retirees, I see an I there. So the benefits that the retirees get are variable. Okay, so what's going to happen is the company is going to put $60,000 each year into the pension fund, or 6% of everyone's salary into the pension fund. And then there's going to be an amount of money into this fund. So they're going to put money into this fund, right? And this fund, the money is going to get invested. It might make more money, maybe less money. So what the retirees are going to get when they retire is going to be variable. They don't know exactly how much money they're going to get when they retire. It's going to depend on how much is in here at the end. It's going to depend on how many people there are when they retire, if the fund made money or not when it got invested. So there's all these variables that go into figuring out what the retirees are going to end up getting. And so that's a defined contribution plan. A defined benefit plan is the opposite. So the employer contributions are variable, but the benefits that the retirees get at the end are fixed. So what this means is that the retired members or the employees will know exactly how much money they're going to get, or they can calculate how much money they're going to get when they retire. And what the company is going to have to do is make sure they put in enough money into the pension fund in order for the retired members to get what they were promised. So it's usually based on a formula what the benefits are going to be. So sometimes so it could be something like this. So you will get 2% of your last year's salary times the number of years of service. Okay, so it's usually based on a years of service. So you'll take your number of years of service times 2% of your last year's, of whatever your last year salary was before you retired. So your last year salary before retirement, or it could be like the last 3 years, right? Or like the top 3 year salary. So the highest salary amounts for your top 3 years, like an average of the top 3 years, right? So an average of the top 3 years. Usually it is based on the years of service that you have in some sort of formula like this. So the benefits that the retired members get at the end, they can estimate this. So they can say, okay, you know, if I'm making $100,000 a year when I retire, and I'm going to work there for 20 years, they can figure out the calculation for that. So what the employer has to contribute is going to be variable. So every year it might be different of how much they have to put into the pension fund in order for the employee to get this result at the end. Because, you know, the employer doesn't know exactly how many years of service they're going to do. They don't know exactly what the last year of salary is going to be, when they're going to retire, how long they're going to live after they retire. So how many years do we have to pay this out? Mortality rates, right? And so even like before they retire, how long are they going to be? Are they going to last in the company? Are they going to quit? Are they going to get fired before they're retired? So there's a lot of variables that go into figuring out how much the employer has to contribute into the pension fund in order to make sure there's enough money for all the benefits for the retirees to be fixed. Okay. So 2 types of plans: defined contribution, defined benefit plans. If lately what's been happening is most companies that have pensions have been doing defined contribution plans. Okay? So because the contributions are fixed, it's easy to figure out how much to contribute into the pension plan. So there isn't too many defined benefit plans anymore because of the fact that the employer has to bear the risk of how much to put into the pension plan. All right, so let's go to the next slide. All right, so basically I just explained the defined contribution. So the employer contributes a defined sum, so either like a fixed amount, like the $60,000, or, you know, related to salary, 2% or, you know, 6% per year, and they contribute that. The employee assumes the risk, so there's no guarantee of how much money the retired member will get after they no longer work. And so, like I said, the plan doesn't specify what the employees will receive. Okay, so they'll receive whatever basically is in that pot at the end. The cost of the plan in the current year is known with certainty. The employer knows how much money they're putting into the plan each year. So it's pretty nice for the employer to know how much is going in. They don't have to put any extra or anything like that. So the journal entries for the defined contribution plan is pretty straightforward because the employer just puts in how much, or just does an entry for how much is contributed into the plan. Okay, so what happens is the pension expense is the amount the company contributes into the plan. So we're going to debit pension expense and credit cash. So pretty simple, straightforward journal entry. Whatever the employer is contributing into the plan gets a debit to pension expense. Okay. So for example, if we were looking at our example of 60,000, so 60,000 goes into the plan each year is what was decided by the company. So then at the end of the year, whenever they contribute, we're going to debit pension expense and credit cash. The way that this could be a more complicated journal entry is if the company didn't contribute $60,000 of cash. So what if one year they're running low on cash and they can't contribute the full 60,000 for 1 year? Then let's say they only were able to contribute 50,000. Then we would set up a payable amount or liability amount for payable that they would have to pay next year. So this could be called, or would be called, a credit to pension contribution payable. And it would be a credit of 10,000. Okay, so if they didn't have the 60,000 this year, but that's their agreement is put 60,000 into the pension fund each year, they put 50,000, and then maybe a month after year end, they would put in this other 10,000. So we'd put up a liability until they would have paid it, and then we would cancel that out. Or it can go the other way around. Maybe the company had some cash lying around and they wanted to put more money into the pension fund this year because maybe they won't have enough cash to do it next year. So the other way it could go is if we were agreed to put $60,000 into the pension fund each year, but we decided to put 70 this year, then we would set up like a prepaid for next year, right? So prepaid pension asset for $10,000 for next year. This doesn't usually happen as much as the other example, because if you have money left over, you're probably not going to just throw it into a pension fund. You're probably going to do something else with it. But if the companies want to plan and want to make sure there's enough money in the pension fund, because they know next year is going to be tight, maybe they'll pay a little extra this year, so then they have some left over for next year. Okay. So this is for the employer contributions. Okay, so this is for the employer contribution. If the plan was a contributory pension plan, which means both the employer and the employee contribute to the plan, then you would have to do a journal entry to show the employee portion contributing to the plan as well. So for the employee, it's going to come out of their salary. So if the employee was contributing as well, employee contribution, what we would have here is in your salaries expense journal entry. So you learned about the salaries expense journal entry in intro accounting. So in the journal entry that you would do for the employee to record their salaries expense, you would also credit a liability for that. So salaries expense would be debit, and then all the deductions like CPP payable, EI payable, income tax payable, right? Those would all get credited and then paid to the necessary, paid to the CRA. And we would also have this pension contributions payable. Pension contributions payable, that would come out of their salary. So that would be something else that gets credited. And then cash would also be credited because that's how much we have to actually pay the employee. Yeah, so what the employee contributes to the pension plan, if they do, it gets deducted from their salary and doesn't even go to the employee. Okay, it goes into the plan right away. So then eventually when it's time to pay, we would get rid of this payable and put the cash into the pension fund. Right, so it's pretty straightforward. Journal entries usually be pension expense debit, credit cash for the amount of money, but if they're, if they didn't pay enough or something, then we'd have to adjust that. And then if the employee is also contributing, we'll have this pension contributions payable as part of the deductions from their salary expense. All right. Okay, so now let's, what we're going to do now is just do an example. So we'll go to question 1. So if you can go into your Excel and go to question 1, so chapter 19, part 1, class exercises, and just pop that up. Okay, so question 1 goes through how the journal entries for a defined contribution pension plan. So what you need to do now is pause this video and go through this example by yourself. Okay, so pause the video, try this example on your own, do the journal entries, and then resume this video after you're done, and you can compare your answers to the take up. Okay, so what I'm going to do is take it up right now, but make sure you pause the video and try it yourself before watching the rest of it. Okay, so Kiran Limited provides a defined contribution pension plan for its employees. Plan requires the company to deduct 5% of each of the employees' gross pay as part of the employee contribution. Okay, so the employee contribution is 5% of their salary, and the company then contributes 7% of the gross pay as the employer contribution. So the employee, so it's a contributory pension plan. So the employee puts 5%, the company puts 7%. Okay. Both amounts are remitted to the pension trustee within 10 days at the end of each month of the previous month's payroll. On November 30th, 2017, Kira reported 29,300 of combined, withheld, and matched contributions owing to the trustee. So this 29,300 is the total of the employee and the employer contributions. So that's what I meant by matched. Right. So this matched contributions is both the employer and employee. During December, Kira reported gross salaries and wages of 276,100. Okay, so let's take a look at the first part. Part 1 says to prepare the journal entry to record December payment to the plan trustee. Okay, so at November 30th, you would have done your salaries expense entry, which would have deducted the 5%. You would have done your pension expense entry, which would have deducted the 7%. What this question is asking you to record the December payment. So the December payment happens 10 days after month end. So on November 30th, you would have recorded your expense accounts. And then 10 days after, you would actually pay the pension trustee. So 29,300 is the total amount you have to pay the trustee. So you would have already set up a pension contributions payable, and now you're actually just paying it out. So we debit pension contributions payable, 29,300, credit cash, 29,300. So this is just showing the payment entry 10 days after month end for November 30th. Okay, so they already calculated it and told you the amount that has to go to the pension trustee is 29,300. So they would have already done the journal entries for crediting contributions payable, and now you just have to reverse it and pay the cash. Part 2 says, what amount of pension expense will the company report for December 2017? Okay, so now we have to do the calculations for December. Calculations were already done for November, but we have to do it for December. So gross salaries and wages expense for December was 276,100. 5% is deducted for the employee and 7% for the employer. Okay. So it says, what amount of pension expense will the company report? Pension expense is just the employer's contribution. Okay, so pension expense is the employer's contribution, so the 7% of 276,100. So 7% of 276,100 gives us 19,327. Okay, so that's going to be your pension expense. You're going to debit pension expense, and you're not going to debit cash because you're not paying that until 10 days after year end. So what we would do is, I'll show you the journal entry. We would debit pension So we would debit pension expense, and we would credit pension contribution payable, because we're not paying the cash yet. We're paying the cash 10 days after month end. So 19,327, 19,327. Okay, so that's your gross salaries and wages times 7%, because that's how much the employer pays. Part 3 asks us to determine the appropriate pension account and its balance to be reported on the December 31st, 2017 statement of financial position. So it's saying what at the end of the year, December 31st, 2017, what basically is on your statement of financial positions or your balance sheet in relation to pension. So we know that we're going to have this pension contributions payable of 19,327 for the employer contribution, employer amount. So let's see how much we have to do for the employee amount. Okay, so the employee is going to contribute, we said up here is 5%. Okay, so go up here, just go back to the question. So the company requires that the company deduct 5%. Okay, so let's go take this 276,100 times 5%. So 276, 100 times 5%. Take a look at what that is. Okay, so that's 13,000 805. So the journal entry is going to be for this. I can just do the journal entry here. So it's going to be sorry. Okay, so the journal entry, we're going to have like a salaries expense of 276,100, right? We're going to have, our CPP deduction. We're going to have our EI deduction. We're going to have our income tax deduction. Yeah, so we're going to have all that. Let me just bring this down a little bit. Okay, and then we're also going to have our pension contributions payable. And that is going to be what we just calculated, 5% of the 276,100, so 13,805. Okay. So, and then we're going to have cash as well. Okay, so we're going to have we have our pension contributions payable up here of 19,327. We have a pension contributions payable down here of 13,805. So 13,805 plus our 19,327. This question asks, what are we reporting as our pension account on the balance sheet? So our pension account is pensions contributions payable, 33,132, which is adding these two amounts here. Okay. So that is your pension journal entries for a defined contribution plan. So it's not too difficult. Basically, your pension expense amount is how much cash you're putting into the pension. And then you might have the pensions contributions payable for any contributory pension plans for the employee. Okay. All right. So now let's go into our, back to our PowerPoints. Okay, and talk about defined benefit plans. All right, so defined benefit plans are all right, so now let's talk about defined benefit plans. So defined contribution plans where the contributions were fixed, the benefits were variable. We're not doing the journal entries for the benefits because the pension trustee takes care of that. So we're only doing the entries for the contributions. But for the defined benefit plans, the contributions are variable and the benefits are fixed. Okay, so the employee knows, or they can calculate how much money they're going to get when they retire. In this case, the employer assumes the risk because the employer has responsibility for making the payments no matter what happens in the trust. So if the trust gets, the money gets invested and the trust loses money, that means the employer has to put in more money, right? So they're responsible for making sure there's enough money in the pension plan in order for the retired members to get what they are deserved. Okay, so the cost of the plan is not known with certainty. As I was saying before, it depends on so many variables. So, employee turnover, mortality, what the inflation is going to be, how much salary they're going to have in the future, when they're going to retire, how many years of service they're going to have. There's lots of variables into trying to figure out how much to put into the pension plan each year. So let's figure this out. Okay, so plans can be vesting or non-vesting. So what vested plans mean, vested amounts become legal property of the employee. Employees are entitled to receive vested benefits even after they leave the corporation if they're vesting, if they've met the vesting period. So what this basically means is that if the defined benefit plans are vesting, that means that there's a vesting period where employees have to be employed for a certain amount of years before they're entitled their pension. So maybe it's a 3-year vesting period. So the employees have to be employed for 3 years, and then anytime after 3 years, if they leave the company, they're still going to be entitled those pension benefits after they leave the employee for the amount of years of service. That's why there's always that years of service in the formula. So if they leave after 4 years, they'll get 4 years times 2% of their salary times their last year's salary before they left. Okay. If they're non-vested, sorry, if the employee leaves before the 3 years are up, then they don't get any of the retirement money. If they're non-vesting, that means the employees are entitled the money right when they start working. Okay, so usually usually what companies do is have a vesting period, so then they can ensure that their employees will stay for a few years, or I guess it's motivation for the employees to stay for at least a few years. So the next question is, how much do we contribute? How much does the employer contribute each year to make sure that there's enough money in the plan for these retired members? So that's a really hard question for us accountants to solve, because we have no idea how much, depending on all these variables, it's going to depend on how much to contribute. We just do the journal entries. We need some help in order to figure out how much to contribute. So what we're going to do is we're going to have the use of an actuary. So some people might know the profession of an actuary. So we would hire an actuary to determine how much to contribute. So the actuary would give us a report of this is the amount that you have to contribute into the pension plan, and then we would do that. So things get a little bit complicated because of what IFRS and ASPE require versus what the actuary is going to tell us to contribute. So there's 3 main methods of determining how much to contribute into the pension plan. So there's the vested benefit method, there's a projected unit credit method, and there's a projected benefit method. So these are the 3 main methods that an actuary will use to determine how much the company needs to contribute into the pension plan each year. But all these different, and there could be a lot more different methods too. These are just 3. There could be a lot more other different methods that the actuary will use and tell the employer, okay, you need to contribute this much money into the pension fund each year. So what IFRS and ASPE did is they said, well, everyone's going to have very different pension expenses on their books because of the different methods being used, which is not really fair. So in order to make things consistent, ASPE and IFRS require that you record pension expense based on the projected benefit method. So when you're recording pension expense for the year, you have to use the projected benefit method. Okay? Or the company has to use this to record their pension expense for the year. But maybe the actuary doesn't agree with putting in the amount of money into the plan based on this projected benefit method. Maybe they want to use the vested benefit method in order to figure out how much cash to contribute. Okay, so the cash contribution that the actuary tells the company, hey, put in this much money based on the defined benefit method, could be different than what the pension expense is going to be on your books. Okay, so we're going to have a different amount for the cash contribution and a different amount for pension expense. That's why the journal entry for defined contribution plans, debit, pension expense, credit, cash, won't work here because these are 2 different amounts. So in that case, you will have a separate journal entry for your pension expense and then a separate journal entry for the cash that the company is contributing into the pension fund. And another thing with defined benefit plans is that it actually does go on to the balance sheet as well. So for defined contribution plans, the pension expense was the only amount that would hit the income statement, but in defined benefit plans, you're going to have an asset and a liability as well. But only the net amount is recorded on the statement of financial position. and it's called the net defined benefit asset or liability. So if it's a positive amount, debit amount, it's an asset. If it's a credit amount, it is a liability. So your liability is called defined benefit obligation. And basically what your liability is all the payments you need to make into the pension fund. So, you hired 10 employees at the beginning of the pension, of when you started this pension fund. And there's a formula of how much they're going to get paid at the end of when they retire. So the actuary is going to do all these calculations and say, okay, you have to pay, $5 million into the pension fund. So that is going to be your liability. Your liability is going to change depending on what happens. So people quit, if more people get hired, the salary is going up, inflation, stuff like that. Okay, so the liability is basically everything you still have to owe into the pension fund. Then you're going to have an asset. Your assets are, it's called pension plan asset, and the assets are everything that's in the pension fund. So you contribute into the pension fund, even though you don't actually have that money because the trustee is taking care of it, and it is still an asset because that's no longer the money that you need to put in the fund is already in the fund, so that's set up as an asset. And then you're going to subtract those two, the liability and the asset, to find out what your net amount is, which, like I said, is recorded. It's called net defined benefit asset / liability. At the end of the period, if the liability is greater than the asset, then it means your pension plan is underfunded. It means you don't have enough money in your fund. If the asset is greater than the liability, then your asset is overfunded. So the pension plan is overfunded, which means you have more money in the pension fund than you need to have in there. Right? Usually what happens is that in reality, pension plans are usually underfunded rather than overfunded. So there's a few different areas for the net defined benefit plans. You're going to have your defined benefit obligation, which is your liability. You're going to have your pension plan asset, which is your asset. And then you're going to have a pension expense. And ASPE and IFRS are different on how they record pension expense. Your liability and your asset are calculated the same way under ASPE and IFRS, but your pension expense and the journal entries are a bit different. So we'll go through ASPE for this video, and then we'll go through IFRS for the next video. So your pension plan asset amount. So every year, what you're going to need to do is figure out what is in the asset account. And in order to do that, you're going to figure out first take your opening balance of the asset account. So opening balance of your pension plan asset account. You're going to add anything that got contributed into the pension fund. Okay, so if the asset is everything that's in the fund, any contributions you made in that year is going to increase the asset account. Then those amounts are going to get invested. So any return you have on your plan assets, so any actual return on the plan assets. So let's say the money that's in the pension fund gets invested and makes a 10% return, that will get added to the amount of money that's in the pension fund. And then what gets subtracted is the benefits paid to retirees. So if your asset account is everything that's in the pension fund, the trustee pays out retirees from that pension fund and gives it to the retirees. So anything that's been paid out is no longer in that fund and therefore would need to be subtracted in order to get the ending balance of your pension plan asset account. Okay, so start with your opening balance of your pension plan asset account, add your contributions, add your actual return on the plan assets, and then subtract the benefits to retirees. To get your actual return, sometimes in the question it'll be given to you, sometimes it won't be given to you. If it is not given to you, how you find out your actual return is you're going to take the percentage, so like the percentage you're going to get, and it will tell you in the question what the percentage is. So like I guess the discount rate. And you're going to multiply that by the opening balance of your pension plan asset. So your opening balance of your asset account. Okay, so you just take whatever your opening balance of your asset account is multiplied by the discount rate, and that's going to get you your actual return. Or it might be given to you in the question, so you just have to look out for if it's given to you or if you have to calculate it. Next is your defined benefit obligation. So your defined benefit obligation consists of, you start off with your opening balance of your liability. Okay, so your opening balance of your defined benefit obligation. You're going to add to that liability any current service costs. So what a current service cost is your actual pension costs related to the current year that you're in. So based on, the current number of employees, their current salaries, the current years of service, what is the cost that would go into your pension account. Okay. We're also going to add our interest cost. When you have, so the liability, the defined benefit obligation, that is like a present value of all the payments that you have remaining to make. So whenever we have a present value calculation, we always have an interest component with it in order to determine what the new present value is. So every year you're going to have an interest component in order to update the present value. So we're going to have an interest cost. The interest cost, if it is given to you, that's great. If it's not given to you, you're going to have to calculate it. The way that you calculate your interest costs is you're going to take your discount rate, so your percentage. So similar to your actual returns, you take your discount rate and you're going to multiply it by your opening balance of your liability. So your opening DBO, defined benefit obligation. You're also going to add your past service cost. Now, past service cost is terminology based on if there is anything in the past that you have to pay out because you started your pension plan later than when you started employing your employees. Anything that was the cost to do with the past is going to be included in that. So let me just actually make that a little bit more clear for you. So let me just make a timeline real quick. Okay, so let's say that you started your company. So you started a company in 2015, but you didn't have a pension fund at that time. In 2018, your company is doing pretty good. You have a bunch of employees and you say, okay, I'm going to start a pension fund for these employees. Okay, so you're going to start a pension. But those employees started working in 2015, but you didn't start the pension until 2018. So any costs from 2015 to 2018 that relate to the pension those would be your past service costs. So if your pension says you get 2% of your salary for the number of years of service, usually it's based on years of service, then they had years of service from 2015 onwards, but you didn't start the pension until 2018. So anything from 2015 to 2018 would be called a past service cost. Another example of past service cost is if you change something in your plan. So let's say in 2015 you had a pension and you said that you're going to put 4% of everyone's salary into the pension. And then maybe a few years later you changed it to say 6%. So what you should do, go back and make up for that 2%. That 2% difference would be a past service cost. Okay, so it's just costs related to either not having a pension at the beginning of when you started your company or changing something in your pension in the pension formula in order which would incur some costs. Okay, so that would be past service costs. So you would add that as well. And what gets subtracted, excuse me, something that gets subtracted from your liability is benefits paid to retirees. If your liability is anything that needs to be paid into the fund, then whatever is given to retirees is less money that you have to pay into the fund. So that gets subtracted. And the last thing here is any extra losses or gains. So any extra losses gets added. So it gets added to your liability. And any gains get subtracted from your liability, right? from your liability, because gains are obviously going to bring down your liability. Losses are going to bring up your liability. Okay. What actual losses and gains are is if there's any big changes. So like I said, the liability amount is what you have to put into the pension fund. So what the company has to put into the pension fund. So if there's any changes, like a bunch of people got fired or a bunch of people got hired, or some people died, or some of the variables or the estimates that they made, something changed, this actuarial gain or loss will account for it. Okay, so if a bunch of people got hired, that's going to increase your liability, so you would add that to the liability. If a bunch of people got fired before the vesting period, right, so before you had to give any pension, then you would subtract that from your liability, because that's less money you have to pay out in the future. Okay, so opening balance plus current service plus interest plus past service minus benefits paid to retirees, plus actuarial losses minus actuarial gains. All right. All right, so let's try to figure out or do those calculations. So if you go to question 2 of the Excel, chapter 19, part 1 Excel. Okay. Like I said previously, pause this video and try this question yourself. And then when you're done, resume this video to see how what the answers are, so you can compare with what you did. All right, so let's take this up. So Reebok Corporation provides the following information about its defined benefit pension plans for 2016. So it gives you all the information, and it says, assume Reebok follows ASPE, which right now, what I showed you, there's no difference between ASPE and IFRS in determining the defined benefit obligation and then asset. Okay. So let's just do A, B, and C for now. So part A says to determine the balance of the defined benefit obligation at December 31st, 2016. Okay. So if you follow the formula that was on the PowerPoint, what you first start with is your net defined benefit, defined benefit obligation. Okay, so you're going to start off with this amount. So defined benefit obligation opening balance, January 1st, 2016 was $2 million. The reason why this is a negative here, because it's a liability. Okay, so it's just showing you that this is a liability, so that's why it's a negative. So part A, determine the DBO as of December 31st. So we start with our beginning balance. So our opening balance of our DBO. And then we're going to add our current service cost. So we have here current service cost of $225. Okay, so we're going to add $225 to that. So I just kept the sign, but you can make this a positive and just keep adding all the other costs. It's up to you. Okay, next thing that is going to affect our DBO is our interest cost. So to calculate interest costs, we're going to take our interest rate, so our 10%, and multiply it by the opening balance of our defined benefit obligation, which is the negative $2 million. Okay, so one thing you have to watch out for before you do this calculation is you want to check your past service costs arising December 31st, 2016. So your defined benefit obligation is at January 1st, 2016. If your past service cost was also January 1st, 2016, then this $25,000 would need to be added to your $2 million in order to determine what the opening balance would have been at January 1st. Because if the past service cost arose on January 1st as well, technically it should be included in your defined benefit obligation at the beginning of the year. So if this past service cost said arising January 1st, we would have to take the $2 million plus the $25,000 and then multiply it by the discount rate to determine what the interest cost was. But because this arose in December and we just only need to work with the opening balance of our defined benefit, to determine our interest cost, we're going to take our $2 million and multiply it by the 10%. All right, so you can see it there, the 200,000 for our interest cost. And interest cost gets added to our liability. So because it gets added to our liability, we're going to, because our liability is already a negative amount, we're going to also have the interest cost as a negative amount. Next thing we can talk about is our benefits paid. We have benefits, oh, sorry, let's do past service costs first. Okay, so because we already were just talking about it. So past service costs arising December 31st, 2016, 25,000. And we're gonna bring it over to our DBO, past service costs, 25,000. So past service costs is also going to be added to your liability. So if your liability is a negative amount, you're gonna have this past service cost as a negative amount as well. And then you're going to subtract any benefits paid. So $100,000 benefits were paid. So we would subtract that. Okay, so I have it here as a plus because I have everything else as a minus. And then you would add or subtract any actuarial gains and losses. At this time, we don't have any actuarial gains and losses, so we can calculate that total. So the ending balance of our DBO, if you add everything, subtract your benefits, we get 2.35 million. So I'm just make that bigger. So hopefully you got that when you try to do it yourself. Next question is determine the balance of the pension plan assets as of December 31st, 2016. Sorry, it's not typo there. Okay, so for your assets, same thing, you're going to start with your opening balance of your asset account. Opening balance as of January 1st, 2016 was 1.6 million. Okay, so start with the 1.6 million. You're going to add anything that was contributed into the pension plan for the year. So contributions to the plan. So this can say contributions to the plan or amount funded. Sometimes it says funded amount. So you're looking for the amount that was contributed into the pension plan for the year. So 262, 500. So that's there. Okay. Next one is your actual return. You're going to add your actual return on pension plan assets. So they gave us a discount rate. We can take the 10%, multiply it by the opening balance of your plan assets, but they also gave us the actual return. So they did the calculation for us. So we could just take that number, 160,000. If you didn't get this number, then like I said, you would just take the 10% multiplied by the opening balance of the plan assets. So that would still get us 160. Okay. So we have that. And then you're going to subtract your benefits paid. So 100,000 gets deducted from your asset account, and it also gets deducted from your liability account. Okay, so we have that. So then if you kind of add up these three, subtract the 100,000, you get 1.922500 as your plan assets ending balance. Part C says, is the plan underfunded or overfunded at December 31st, 2016? And what is the balance of the net defined benefit or liability at December 31st, 2016? So this net defined benefit asset / liability, this is what goes on your statement of financial position. This is what goes on your balance sheet. And it's going to be the difference between your ending balance of your liability and your ending balance of your asset. Okay, so if you subtract those two amounts, you'll get 427,500. And it's a negative amount because it's a liability. So our liability is higher than our asset, which means the net amount is going to be a liability of 427,500. And the question was, is it overfunded or underfunded? If your liability is higher than your asset, then it is underfunded. That's what that means. Okay. So it is underfunded, and it's a net liability amount of 427,500. Okay, so that was part A, B, and C. So let's go back to the PowerPoint and look at how do we do part D, which is pension expense. Right? So ASPE and IFRS are a little bit different on how they calculate pension expense. So we'll take a look at ASPE here. So ASPE says that to get pension expense, you're going to take your current service cost, so add your current service cost, which we already are using in your defined benefit obligation. So it's going to increase your liability and also increase your pension expense. You're going to take your interest cost, so the same one that you use to calculate your ending balance of your DBO. You're going to subtract your actual return on plan assets. So pension expense, if you made money on the plan assets by investing them or by the trustee investing them and it made money, then that shouldn't be an expense, right? So that's going to be deducted from your expense. You're going to add your past service cost, and then you're going to add any actuarial losses and then subtract any actuarial gains. Okay, so just like you would in the liability. Now, most of these hit the liability, right? Current service costs, interest costs, past service costs, and actuarial losses. Those are going to be a credit, which is going to increase your liability, and it's going to debit your pension expense. The actuarial gains would decrease your liability and decrease your pension expense. So debit your liability, credit your pension expense, and your actual return on plan assets is going to increase your asset, which means it should decrease an expense. Okay, so those 5 things are going to go into your pension expense calculation for ASPE. And then we have last thing we have to do is we have to do journal entries. So we have 2 journal entries for ASPE. Like I said earlier, the amount of cash that's contributed into the pension plan is not going to be the same amount as what your pension expense is going to be, because ASPE and IFRS have a specific method that they use, the projected benefit method, on what can be recorded as pension expense for the year. But that's not going to necessarily be the same amount of cash you actually put into physically give to the trustee to invest. So it's going to be a different amount. So it's going to have 2 different journal entries here. So the first journal entry is going to be for pension expense. We're going to debit pension expense, and then we're going to credit that net defined benefit asset / liability. So that's your net amount that goes to the statement of financial position. So an expense is going to decrease your, an expense is going to credit your liability or asset liability account. And then the cash contribution, we're going to debit our net defined benefit and we're going to credit our cash, because contributions will increase the asset. We saw that the asset gets increased by any contributions that are made, so that would be a debit. All right, so let's try that. Figuring out pension expense. It's easier if we have a question to help us. So go back to question 2 and we'll do part D. So part D says, determine the pension expense for the year end 2016 and prepare the journal entries related to pension. So if you just follow my list on the PowerPoint, pension expense consists of our current service cost. So we add our current, so we'll start with our current service cost, $225. We're going to add our interest costs. We know we calculate our interest cost as $200,000. So we can just, so that's that 10% times the opening balance of our liability of our DBO. So that's 200,000. So we're going to add that. Interest cost 200,000. We're going to subtract any actual returns on plan assets, which we have. Actual return 160,000. So subtract that. We're going to add our past service costs. We already know that from the first question. That was $25,000. Okay, so we're going to add that. And we don't have any actuarial gains and losses. So if we add everything up, we get $190,000 as our pension expense for the year. Okay, so those 5 elements here, we only had 4 because we didn't have any actuarial gains and losses. And then just remember that actual return on plan assets gets subtracted from your pension expense. The next part of the question is the journal entries. So 2 journal entries, one for pension expense. So first one, debit pension expense, $290. So whatever you calculated as your pension expense. Credit net defined benefit liability or asset, $290. And then our second one is for the cash contribution. So if you go back up, it says contribution to the plan was 262,500. So we have to record the cash coming out for that. So we're going to debit our net defined benefit this time, and we're going to credit our cash, 262,500. Okay, so this, I feel like this chapter isn't too difficult as long as you know what gets added and subtracted to pension expense, what gets added to subtracted to plan assets, and what gets added and subtracted from the defined benefit obligation, so the liability. Okay, otherwise, it's pretty straightforward. You just need to know what gets added and subtracted and then do the totals there. And just to double check our work, so we said that we're going to have a liability of 427,500 at the end of the year. The question told us what our opening balance was. So it says a net defined benefit, it's a liability that's negative of 400,000 at the beginning of the year. Okay, so our opening balance of our net amount at the beginning of the year was 400. So let me just do a quick T account to show you how this all kind of works. So if this is our T account for a net defined benefit, our net defined benefit is what goes on the balance sheet. So it's not just both, it's not both. So our net defined pension benefit, something like that. Net defined pension benefit we have right now as a liability. So it's 400,000 as a liability. And we know it needs to be 427 at the end because we calculated that earlier. So it needs to be 427,500. To get there, what we did was we credited 290, right? So we credited 290 of our net defined benefit account, and then we debited 262,500. So if we start off with 400,000, add 290, we're going to subtract 262,500. We should get 427,500. All right, so that's kind of how that all works out. And that's the same as what we calculated. I'll show you where we calculated that. And we calculated that right here, 427,500. Okay. All right, I hope that makes sense. So this video was on majority on defined benefit defined benefit plans, a little bit on the defined contribution plans, and then figuring out pension expense for ASPE. So the next video will show you pension expense under IFRS. Thanks for listening. Take care.